If you've ever missed big moves because you weren't sure if the market was actually trending or just faking you out, give me a few minutes. I'm going to show you one of the most powerful tools for spotting true momentum shifts in real time. This isn't just another indicator that lags behind price. It can literally help you see when a trend is building strength, when momentum is dying, and when the market is about to trap traders in a range. And here's the best part. Once you understand how to read it, you'll be able to time breakouts and pullbacks with far more confidence. Stay with me, because if you learn to use this properly, this could easily become one of the most valuable tools in your entire trading setup. Let's get it on the chart first. Head over to TradingView, load up any chart and any time frame you like, then click on Indicators. In the search bar, type Step, Channel, Momentum Trend, and select the one by ChartPrime. As soon as you add it, you'll notice the unique way it plots the trend. At the center is a core midline that looks almost like a staircase instead of a smooth curve. It doesn't react to every small tick in price. Instead, it holds its level until the market creates a genuine confirmed pivot high or pivot low. When that happens, the midline snaps to a new level. That snapping behavior is the key because it filters out a ton of noise while still reacting quickly to actual structural shifts in price. Wrapped around that midline are two dynamic volatility bands. These aren't static Bollinger Bands. They are built using ATR, average true range. So they expand and contract in real time based on market volatility. When the market gets volatile, they widen. When things are quiet, they tighten up, which makes them perfect for gauging whether a move has real strength behind it or if the market is just chopping sideways. Now, the most intuitive part of this indicator is the candle coloring. When price breaks above the upper volatility band, the candles flip to green, signaling strong bullish momentum. When price drops below the lower band, the candles turn red, showing strong bearish momentum. And if the price is stuck between the bands, the candles go orange, telling you the market is in a low momentum sideways range. You'll also notice small diamond symbols plotted on the chart at pivot points. These mark the exact moments where the midline recalculates and snaps to a new level, which can give you a clear view of when the market confirms a new structure. Before we get into strategies, let's quickly look at the settings.
Do you feel like everyone around you benefits from artificial intelligence, but you have no idea where to start? Don't wait any longer. Start today. Our free trading bot is simple to use, powered by artificial intelligence, and can earn you up to 1% profit every single day. Over 500 members have already joined. Click the link below now to get free access. This is your chance to harness the power of AI and take a step toward a financial boost.
Open the indicator settings, and you'll see the main option is the length. This controls how sensitive the indicator is to forming new pivots. A lower length value makes it more sensitive, perfect for scalpers, and a bigger value makes it wait for bigger price swings before snapping to a new level, which is great for swing traders and position traders. This one setting alone lets you tailor the indicator to any market or trading style. So how do we trade with this? The most straightforward way is to use the color shifts to identify market phases. If the candles have been orange and you suddenly see a green candle break above the upper band, that's your early signal of a potential bullish move. A simple strategy here would be to enter a buy position as soon as the first green candle closes above the band. Place your stop loss just below the most recent structural low and let the trade run, targeting a 1.5 or 2-to-1 risk-to-reward ratio. For a sell trade setup, it's the exact opposite. If the market has been consolidating in orange and then prints a red candle breaking below the lower band, that shows bearish momentum taking control. Enter a sell position at the close of that candle, place your stop just above the recent swing high, and aim for the same 1.5 to 2-1 risk-to-reward. Here's a quick buy example. Here we can see the market was chopping sideways with orange candles for several bars, showing no momentum. Suddenly, a strong green candle closed above the upper band. At the same time, the midline snapped higher, confirming a structural shift. This condition is not that necessary, but it is a good signal to differentiate between a strong signal or even stronger signal. So we can enter a buy trade as that candle close. You can place the stop loss just under the last swing low. and the take profit target can be set at 1.5 times the risk. After some time, as we can see, the price immediately followed through with a clean bullish run. Now for a sell example. Here we can see the price was in a slow up move, but momentum started stalling and candles turned orange near the top of the range. A sharp red candle closed below the lower band. That was our signal. So we can open a sell position over here. We can set the stop above the recent swing high for a sell trade. One of the most powerful ways to use this indicator is to combine it with pullbacks. Let me quickly show you how you can use that method also. In a trending move, after the first green or red candle appears, you'll often see price pull back towards the midline. If the trend resumes and prints another green or red candle off that midline bounce, that's a high probability continuation setup. Adding price action confirmation like a strong engulfing or rejection candle after the pullback makes the trade even stronger. Another tip is to watch how the candles react when they hit the extreme edge of the bands. If the price blasts through the upper band and keeps printing strong green candles without hesitation, it's a sign of heavy momentum and you can let your winners run longer. On the other hand, if the price touches the band and immediately stalls or turns orange again, that can be an early warning that the breakout lacks strength. For a buy setup, imagine the market is in a strong uptrend and the candles are printing solid green above the upper volatility band. After a big push, the price starts to pull back and drops inside the channel, with the candles briefly turning orange. This is exactly the cooling off phase we're waiting for. As the price stabilizes, it taps the midline and then bounces back. The next candle closes green and pushes above the upper band again, signaling that buyers are stepping back in. That's the confirmation we need. We can enter a long trade as soon as that green candle closes, with the stop loss tucked right under the recent swing low created during the pullback. For the target, aiming for at least a 1.5 risk-to-reward ratio works well, and if the trend continues strong, you can even trail your stop under the midline to ride the move further. Of course, no indicator is 100% accurate. You will still see false signals, especially in low volume or news-driven markets. That's why you should always combine this with proper risk management. A good rule is to never risk more than 1% of your account per trade, and to always aim for at least 1.5 reward. That way, even with a few losing trades, your winners cover the losses and grow your account over time. If you use this tool correctly, you'll be able to filter out a lot of the noise that kills traders in sideways markets and instead focus on clean, high momentum setups. Take a few minutes to practice this on different charts and timeframes. It can completely change the way you see momentum and structure working together. If you found value in this breakdown, hit the like button and consider subscribing for more strategies like this. This might just become one of your go-to indicators for spotting and trading trends effectively. Thanks for watching the video. Till the end, I'll see you guys in the next video.